Well, we had another pullback in the stock market today. In particular, it was those technology-oriented companies that did continue to struggle. Some of the other areas of the market were holding in there just fine, but it does seem like the NASDAQ has been kind of the whipping boy of this market here over the last week or so. So we're going to take a peek at that. We're going to see where we stand with the rest of our postures across the other broad indices, and then we're going to take a look at a trade application on one of those indices because we do have a specific trade signal that's setting up as of today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 6th, 2018. First of all, if you're new, welcome aboard. We're grateful to have you in our audience tonight. Remember, you can go to YouTube and subscribe to our channel, and that way you can always be alerted anytime we post new videos. We also have a description area there at YouTube that you can sign up for a email distribution list. And what that entitles you to is not only the announcement of when these videos become available, but also what stocks are giving you overbought and oversold cluster signals on the S&P 500. In addition to YouTube, we're also heavy users of Twitter. My handle is @BrandonVanZ. We really appreciate you guys that go out of your way to click like and retweet on Twitter whenever we do post these Market Outlook videos. It helps alert us that you guys get value out of them. In addition to Twitter, we're also on Facebook. You can see the group that we've established embedded on the logo in front of you. So with that, let's go ahead and dive into the analysis of the markets. As you can see, I've got the 4 grid pulled up in front of us. For those of you that are premium Market Scholar subscribers, remember this is just chart 4B in your 29 chart package. As you can see, all 4 of our indices continue to have green background colors surrounding today's candle. And what that signifies is that from an intermediate term perspective, we continue to be bullish. Now remember, just because that's how we establish our posture here doesn't mean that's how you have to establish your posture. This is just one of many different ways you could establish posture. But intermediate time period is kind of looking towards the next couple of months as opposed to the next couple of days. Obviously, there's been more pressure on the market here over the last week. I mentioned during the intro that the NASDAQ is the one that's really struggling the most here recently. You can see that down here in our lower left-hand corner, the NASDAQ composite kind of peaked out here at an all-time high of 81.33, and we've gone all the way down here to 79.22. But in doing so, you'll notice that we have not jeopardized our uptrend as of yet. In fact, we continue to be above a rising moving average. In fact, we actually talked about that here today in one of my classes. Most of you know that I teach my question and answer session class on Thursdays, and today was no exception to that. We had 3 hours worth of excellent questions and some answers from myself. So here are some of the different questions we covered for those of you that missed it. Questions about using buy limits, question about Facebook, question about Twitter, question about dividend champions and using that on a ratio chart, talking about AMD and a profit management, talking about Legg Mason, talking about Tupperware, talking about AT&T, Verizon, Coca-Cola, Pepsi, talking about Illinois Tool Works, and then here's the one that I was going to reference. Took me a while to find it. Thanks for bearing with me there. But at the 1 hour and 41 minute mark, Tim asked me what my thoughts on a bear call spread on QQQ were, and he was looking at the October 188, 190 with a 51-cent credit. So feel free to go back, watch that recording to see how I answered that. But part of my answer was it might be a little bit early at this stage to get too aggressively bearish on the NASDAQ. And the reason for that is we still have a series of higher highs and higher lows. Now, it's true, we're getting closer and closer to breaking that, but we're still above a rising moving average. So we don't want to discount that too much. We have to remember that when a particular market or an index gets momentum behind it, the path of least resistance is the direction in which it came from. And clearly, if you look at the NASDAQ, it's been from the lower left to the upper right. So until that changes in some more dramatic fashion where we see support levels being broken, the assumption is that it will catch some sort of a bid. Now, that doesn't have to happen, but you have to kind of go into your trading decisions with various assumptions. Sometimes they'll be correct, sometimes they won't be, but you have to have some sort of reasoning behind why you're going to place your next trade. So right now, the NASDAQ does suffer a little bit of bearishness here in the last week, but continues to have that bullish posture. Remember, as long as that green line is in the upper reversal zone down there, that's our intermediate term line on the market forecast, we would consider that to be bullish. In fact, we have what's known as a bullish intermediate confirmation signal as well, because we have the green line that continues to be bullish as of now, and that's combined with the red line in the lower reversal zone down here. In fact, we have that exact same setup off to the right-hand side here as well with the Russell 2000. Notice that the Russell 2000 has also pulled back for the last 3 days or so and has a similar setup using that market forecast indicator. You'll notice again, green line in the upper reversal zone, red line in the lower reversal zone. But unlike the NASDAQ, the Russell 2000 actually has that blue line between 50 and 20. And while that blue line, which is the near-term line, so for those of you that are swing traders, you might pay a little bit more attention to the blue line than to the green line. Well, that is a good, healthy exhale at that particular point. That's the way it's kind of viewed. So it's not part of the confirmation signal specifically, but it's a nice additional feature to kind of look at to see if it's setting up the right way. And so, you know, of the two, maybe the Russell 2000 has maybe a little bit of a better setup right there. But, you know, the point that I wanted to make is, yes, we did have down movements in most of the markets. The Russell 2000 is down 0.76% today. NASDAQ was down 0.91% today. S&P 500 was down 0.37% today. The Dow managed to eke out a slight gain, up 0.08%, but all of them remain with their bullish postures. None of them, if you look at these charts, suggest that there's massive breakdowns of support yet. So we'll keep our eyes peeled, and of course we'll adjust accordingly, and news can come out at any given moment to check our expectations. But until we see something a little bit more dramatic, we're assuming that this is a market that remains in reasonably good shape. All right, let's take a peek here now at our next chart setup, and this will be chart 4C. This is our 3 green arrows chart setup. Here you'll notice that we do not have 3 green arrows in any of our charts. So there's a little bit more deterioration on this chart 4C than what we saw on the previous posture setting chart. You'll notice that we did get a red arrow to creep in on the MACD on the S&P 500, the Dow Jones, the NASDAQ composite, and the Russell 2000. So it's really the MACD that's the problem. In fact, it's kind of interesting that the stochastics remain with green arrows across the board, and so do the 30-day moving averages. So really, it's kind of interesting. All 4 of our indices right now are showing us 2 green arrows and 1 red arrow, and for each of the 4 cases, it's the red arrow is the MACD that's the problem. That's the momentum-based indicator there. So again, we'll keep our eye on that, and we certainly want to respect the fact that this is a market that's lost a little bit of momentum here in the last week or so, but it doesn't mean that this market is down and out for good. As we take a look at our longer-term version of this 4 grid, let's take a peek now at 4D. And this is going to be a 3-year chart here. Each one of these candles are weekly. And so this chart setup might be a little bit better for those of you that don't have the ability to rotate your money as actively. This is maybe for folks that are trying to apply some of their investments in their 401ks where they have limitations about how actively they can trade. So the idea here is it's the 10-40 crossover method. We're using a weekly candle chart, so it's the 10 exponential moving average represented in the orange, and the blue line is going to be the 40-period exponential moving average. And what we're basically looking for are just the moving averages crossing over themselves. And whenever you see the green background color of the chart, it is a reminder that at that moment in time, it has a bullish posture from that particular perspective. The reason for that is the orange line crossed up and above the blue line. Now, in all 4 of these charts cases, that happened over 2 years ago. So for those of you that didn't do anything in the stock market except for simply went into the stock market 2.5 years ago, whenever we got the crossovers of these various indices, you've probably had a very good experience. And for some of you, that may be something to consider. Obviously, we're not here to tell you what you should or should not do, as we're not your licensed financial advisors. But if you find yourself over trading and you feel like you're always on the wrong side of the trade, and you want to kind of step back and try to take advantage of the longer term views, then it's possible that something like a 1040 crossover method could be something useful for you. Let's now take a peek at some of our 12 grid analysis, and that'll start us off with the intermarket analysis. And reminder, whenever we look at these particular 12 grids, the background color reminds us what the posture is using the intermediate term line on the market forecast indicator. So when we see green background, it means we have a bullish posture. When we see a red background, it means we have a bearish posture. So as it stands right now, we do have a bullish posture on the VIX, but remember, that's kind of an inversely correlated instrument. So not necessarily exciting to see that the VIX has caught a little bit of a rise here in the last week. Again, NASDAQ getting hit pretty hard in the last week. Not a huge surprise to see the VIX go up. But we'll keep our eye on that. At this current level, remember, the VIX is still only at 14.65. So we have to kind of keep in mind that historically the VIX has been above 20 many times in history. So right now we're still at historically low levels. Yeah, we're not quite as low as we were maybe 3-4 weeks ago, but it's still very low. So not a tremendous amount of fear in the marketplace at this current juncture. The other bullish charts on the board are foreign bonds, and then there's the US dollar. Yes, we can't quite shake that. The US dollar has been really one of the key stories of 2018, at least from my perspective. And it really does cause reverberations throughout much of the financial community. Remember, when the US dollar is strong, commodities and also foreign stock markets tend to struggle on a relative basis. In fact, we had that exact discussion last night in my strategy lab class. For those of you that are premium market scholars, if you want to hear my thoughts around that topic, feel free to go check out that recording. But, as you can see here, with the US dollar continuing to go higher over time, it's causing some pain for some of the commodities. Notice that gold is in a little bit of a pain train to the downside. We're seeing ag commodities also struggling. And then crude oil is not going down at the same rapid descent, but it's not lighting the world on fire either. You can see that crude oil does have a bearish posture, but its price action is somewhere in the middle of the range over the last 3 months. So crude oil doesn't look nearly as bad as ag commodities and gold have struggled under that strong dollar. If we take a look now at our next 12 grid, let's take a peek at those foreign stock markets. And you can see that there's only one green light on the board, and that's down here with Israel. Israel's been one of those country ETFs that I've regularly brought up during this presentation as being one that has been more resilient of these 12 here. Now, obviously, there's a lot more countries out there than these 12 that you see, but it is a reminder that most other country ETFs are struggling right now. We're actually quite fortunate here in the United States, where our markets have remained quite resilient, quite strong. In comparison to the vast majority of financial assets across the rest of this planet. But Israel remains one of those bright spots where it's kind of bucking the trend of what all the other countries are seeing on the board here, and it's forming its own set of higher highs and higher lows with that bullish posture. And of course, that green moving average reminds us that price is above a rising moving average. And as you look at all the rest of the charts on the board, there's not one other single chart that has a green tip to the moving average as it stands right now. So it really just highlights how strong and resilient Israel has been. Otherwise, it's been kind of a house of pain out there for a lot of other foreign stock markets. So if you are looking for bearish trade setups, perhaps there's something to be found in the foreign stock markets at this juncture. If we now take a peek here at our U.S. sectors 12 grid, you'll notice that we have most of the U.S. sectors actually bullish. So again, notice the difference there. We just got done talking about foreign stock markets and how most of them look very ugly. Now we're looking specifically at the United States, and in this case, most of the sectors here are still bullish. Yeah, there's been a few kind of pullbacks that we want to be a little bit concerned about. You know, we do have three pink charts on the board. So the financials, the materials, and the energy sectors would be considered bearish at this point using that intermediate term posture. But all the rest of the sectors are actually still bullish, including the technology. That just goes to show you how strongly the technology stocks went up about 2 or 3 weeks ago, that they could have such a give back in the last week and remain bullish at this point is actually saying something. So some of you might look at that saying, you know what, that's a long lower shadow there at a potential support area of that moving average. Who knows? Maybe we go on another run here with technology. But as we look at some of the other charts, things look decent, you know. Here we go with discretionary in the upper right. Yeah, a little bit of a pullback in the last couple days, but we retain that trend of higher highs and higher lows. Healthcare has been very resilient. Real estate has been very resilient. And utilities have been very resilient, which reminds me as well, remember that on the weekends, I do the sector selector, so I'd encourage you to click like and retweet if you appreciate those when I do post them to Twitter. But the point that I want to make by bringing you over here and showing you this right now is that if you look at healthcare, real estate, and utilities, they've really been dominating the top portion of my rankings for the last 5 weeks. Now, I know it's not exciting to see real estate and utilities be up there near the top. I get it. You don't have a lot of opportunities in those areas if you're looking for some strong growth. But you know, we have to remember that we've got to trade what the market gives us. We can't drag it out of the market. And right now the market's telling us that those are some of the more resilient areas, and that's what we keep on seeing on the charts as well. You look at those areas. There's healthcare right there. It looks very strong. There's real estate. Looks very strong. In fact, so strong, you got an overbought cluster signal right here as of today, so we'll keep our eye on that. And then utilities. Notice that utilities broke out to 3-month highs as of today. So again, some of the strength there in the more defensive areas of the market. You can also see telecom, staples, and industrials also remaining with a bullish posture. All right, so that brings us now to our trade application example of the day. And for that, I do want to come back on over here to chart 4A. And I want to pull up IWM. Now, the last time we took a trade on IWM, at least when I've done these presentations, we did a iron condor on it maybe a month or two ago. And that was during this period where the IWM was going sideways. We took a max gain on that particular trade because it continued to go sideways after we placed the iron condor trade. But some of you might have noticed on Twitter and in some of my classes, I had mentioned that I'm glad we got out of it when we did, because when the IWM did break out here in the last month or so, my thought process on the IWM has changed a little bit as well. Back here, I was very neutral on IWM until I saw some sort of a breakout. That breakout occurred, which now means I am slightly more bullish than neutral. Now, I'm not wildly bullish. Obviously, we have a bull market that's long in the tooth here, so I don't think that the IWM is going to double in the next year or anything like that. But, you know, if I have to fall on one side of the fence or the other, since we've broken out to the upside, I'm now slightly more bullish than neutral, and I'm slightly more bullish than bearish. And therefore, when we have a situation like this where we had a breakout of that index, we've had a nice pullback here over the last 3 days, but we retain that bullish posture. We can see that with the background color being green there, and we're still above a rising moving average, which is why the moving average itself is green, combined with the fact that we have what's known as a bullish intermediate confirmation signal. Remember, that is constructed when we have an intermediate term line that's bullish, a red line or a momentum line that's in the lower reversal zone, and for an even more ideal setup, having that near-term blue line between 50 and 20, and that's exactly where we find ourselves right now. So what I thought we would do here today is another higher probability trade. Remember, nothing is ever 100% guaranteed, but you know, if we can try to set the odds in our favor of above a 50% possibility, generally that's something to consider. In the past, we did the iron condor. Today, I'm going to do 1/2 of the iron condor, meaning I'm going to do only the bull-put spread side of the equation. So in order to do that, I'm going to come over here to the trade tab. You can see I've already pulled this up down below here. So I'm concentrating on the October contracts with 43 days until expiration. you'll notice that I've sold the 67 or 167, sorry, and that is our delta of 33, and I'm buying the 166 put. And so the combination of those two things creates a credit of 23 cents. So sometimes you'll hear these referred to as credit spreads. Sometimes you'll hear me refer to them as bull put spreads, just to kind of remind you that this is a bullish trade. However, as long as the stock, or in this case the ETF, does not plunge, we can make money on this trade even if it doesn't go up. Remember, when we sell the 167 put as part of this spread, we're basically saying that we don't want this $170 current stock to fall more than $3. So if it only falls $2, we'll make money. If it goes sideways, we'll make money. And of course, if it goes up, we'll make money. What we don't want for it to do is to go down too dramatically. Now, if it does, that's why we have the 166 put that we are buying that's embedded into the spread. If it goes below 166, that's kind of our insurance contract per se. Yes, we'll still lose money, but we won't lose incremental amounts of money the further that it falls below 166. So that's kind of our line in the sand right there. So if you look at your return on risk on a trade like this, you can click confirm and send and take a peek. Now, obviously, you're going to adjust this to however many contracts your position sizing suggests, but in this case, if just doing one contract, it'd be $23 divided by $77, getting those right off the order confirmation right there. And that reminds us that this is a 29.87% return on risk. So if you round it up, it's a 30% return on risk to place that trade if you so desire. Now, you could also just go ahead and change this credit to 24 cents to get up and over that 30% if you so desired. It would be a slightly less chance that it would get filled. So you have to kind of weigh that decision on your own. But remember that, what we're basically saying, let's get that break even here. So that break even is 166.77. If we come back over here to the chart, hang on just a second. I got to close that down. 166.77 is our line. So let me draw that. Okay, 166.77. And I'll hit OK. And so that line right there represents kind of our wiggle room. Basically, it's a bullish trade, so we would prefer if this thing goes up from here on out. But if it doesn't, and it continues to drift lower, as long as it catches a bottom somewhere prior to that blue line, then the trade should be okay. So if you think that the small caps are going to start plunging here, you're probably not going to want to take this trade. If you think that the small caps are about ready to catch a bounce at some point in the coming days, then perhaps it's a trade that you place in your paper money account just for practice. So with that, let's go ahead and place that trade. So I'm going to go ahead and click confirm and send and ship it off to the market. All right, well, I want to thank you for joining me here tonight. Exciting day, of course. NFL kicks off tonight. So for those of you that are football fans, we'll be watching the defending Super Bowl champions, the Philadelphia Eagles, take on the Atlanta Falcons. So it should be a fun game. And, of course, the stock market continues to roll forward as well. A little bit of a hiccup here, a little bit of a disturbance in the force here in the last couple of days, but it has not wrecked the bullish uptrends that have existed for much of this summer. So don't read too much into it until you see some broken support levels out there. So with that, I want to wish you all the best with your trades and your investments. Remember to click like and retweet if you get value out of these videos, and we'll see you next time. Take care, everybody. Bye-bye.